Markets have been very turbulent over the last month. China's been on everyone's mind, along with a potential Brexit and looming interest rate rises. I'm here at Columbia Threadneedle Investments to find out what's been happening. Hi, we are here with Leigh Harrison, Head of Equities in Europe, who's just come out of his investment themes meeting. China has been a very big topic on the agenda today. What do your fund managers say?
We're still quite concerned or quite cautious about the economic growth outlook for China, where it's clear that growth is slowing down. And one of the consequences of that is that we're seeing impacts knock on into the European economy and to companies in the UK and the US. The stock market's obviously been very volatile on the back of a huge run last year and significant profit taking this year, but we don't think that that's necessarily as significant as the change in the economic activity within China. So we remain optimistic about growth in China, but against a backdrop of slowing growth there.
The pressure to raise interest rates is concerning a lot of investors at the moment. How do you think bond markets have been behaving in response?
Well, bond markets really are focused on when interest rates go up rather than whether they'll go up. There's some debate about how much they'll move when they first move, but really the bond markets are trying to work out, will the first move in interest rates be in the fourth quarter of this year, or will it be pushed out into next year?
Yeah.
And the drivers for that really are the news flow on economic growth. So if growth appears to be slowing down, then bond markets tend to expect interest rates to go up later on, bond yields fall, and that's what we've seen over the last few months, is an ameliorating of growth forecasts and a fall in bond yields.
The dollar has been rather static recently, which is fair to say. Do you think that we are in for a period of slower global growth?
Yes, I mean, it's quite clear from the lead indicators that global growth is not as strong as people were expecting earlier in the year, but it's still positive. And the dollar flatlining, I think, is really a reflection of the fact that in the early part of this year there was some concern about global growth, and people tend to buy the dollar for security. As people have got more comfortable with the growth outlook, the dollar has stopped going up.
So how would you say commodities are affected in this environment?
Well, I think the key driver for commodities actually has been the demand-supply imbalance rather than the dollar. And what you've got is obviously very strong growth historically in China, and China was a huge consumer of many commodities, encouraged commodity producers to increase production, and you've now got excess production and weakening demand in China. That's forced commodity prices down because of the supply-demand imbalance, and I think that's putting a lot of pressure on emerging market currencies, and that's what we're seeing in emerging markets at the moment.
So will you be considering changing the focus of your themes considering the recent events?
No, I mean, it's interesting. We discussed the thematic outlook, and I think we always have felt that economic growth would be below the best expectations in the market, and we've invested quite cautiously as a result of that.
Yeah.
But we still feel that the themes that we have in place, where we're focusing on reliable growth, reliable income, and companies that are well financed, we still think that most of those themes are still okay for the current environment.
Leigh, that was very enlightening. Thank you very much for those insights, and thank you for watching. We'll be back again next month.